It's not easy investing like the world's great hedge fund managers, but my next guest, Maz Jadallah from AlphaClone, has figured out a way to do just that. He's here to tell us about it. Welcome, Maz.
Thank you for having me.
All right, your AlphaClone Alternative Alpha ETF, ticker ALFA, has beaten the S&P by about 6 percentage points over the past year. It's up around 36% in the past year. Can you tell me how you do it? How do you structure it?
Sure. Very briefly, we think in order to do well in the active management world, you really need two things: access to the best active managers there is and the skill set to choose amongst them. We can access any active manager or hedge fund that we like through their hedge fund their public disclosures with the SEC. It's called Form 13F HR. And we've built a data set that goes back to 2000 that includes these filings for 400 managers. The second part, selection, we do through something called Clone Score. We've developed a Clone Score, which really is just a persistence and return score for when using a manager's filings over a long period of time. So we pick managers with the highest Clone Score to make it into our index, which is tracked by the ETF.
So do you like some managers like Einhorn more than Ackman, or Icon more than Dan Loeb? And what happens if they have an off year? Do they fall according to their clone score?
Yeah, we repeat clone scores every 6 months in order to include new managers that we add to the data set, but also the latest performance based on their public disclosures. You know, research shows that there is persistence in returns amongst hedge funds, but it happens over short periods of time. So really the trick is in having a sort of automated, non-emotional way to evaluate these managers based on their long selection skill, and that's what Clone Score is.
So right now, two of the biggest holdings in your fund are AIG and Apple, very popular. If you've been listening to the hedge fund managers, this is all quantitative. You don't care about these stocks, the fundamentals. You're just watching the 13 Fs.
Right. We follow our models religiously. I have opinions, obviously, about the stocks that we have, but my opinion doesn't matter.
And what happens if two hedge fund managers are on the opposite sides of a stock? You look, for example, at Herbalife, where Dan Loeb and Carl Icahn were long it, and Bill Ackman, another very prominent hedge fund manager, was short it. What do you do?
The forms that we follow only disclose the manager's long positions, and the strategies that we develop are made up of long positions only, although we do things like dynamic hedging to protect against market volatility.
Actually, this year we keep hearing that the hedge fund managers are underperforming the market. Right. So why not just go with the S&P, like a Spider, the SPY, or the Diamond? You know, why get into such a fancy ETF like the Alpha?
You know, it's really very simple. It's a hedged equity strategy. It accesses what we think are some of the best active managers in the world in a very unique way. You have no manager risk because you have no direct access to these managers. There's no switching costs when managers begin to underperform. The way we construct our strategies includes multiple managers, so it's like a really virtual fund-to-fund. And so we think and it's got downside protection through this dynamic hedge, and I think in this environment that's very appealing.
And those guys are taking 2 and 20. How much does your fund cost?
95 basis points for the ETF.
Cheaper, right?
Yes.
And it's outperforming the market, and some of these guys aren't. So good luck with your fund.
Thank you for coming,
Maz.
Thanks a lot.
Thank you for watching The Street.